All right, welcome back. This is the second part of the Divorcing the Business Owner or Entrepreneur webinar, brought to you by O'Neill Wasaki. I'm Michelle O'Neill. I'm joined by Jere Hight and Ryan Segall, who are both attorneys at my firm. And we're also happy to have Robert Bales, who is a CPA with Bales & Company and does forensic CPA work. So welcome, gentlemen. Welcome back to section 2. So this one, we're going to talk about what is the asset and how is it divided. So let's start with entity theory. Jere, what is the entity theory of assets?
Well, the entity theory is that it is a separate entity from the person, the owner. So you have different categories. Sole proprietorship, which is not an entity, it is the owner. There's no distinction. And then
There's no like legal boundaries.
There's no legally created entity, and this is basically, or one of the main reasons for this is to segregate liability of an owner and keep it with the business and not with the personal person. So that's one of the many reasons why you have this. But you have sole proprietorship, then you get into the entities that take creation. That there has to be a filing to create, so corporations, whether you're a normal corporation or an S corp if you declare that. And then we have unlimited liability corporations. There's a lot of different ones. And then we have an entity which is partnership, which does not take a formal filing. We'll get into that in more details. But those are your major ones.
Okay. So let's talk about partnerships real quick so we can just kind of get some definition around these things. Does a partnership require a written agreement?
No.
So one of the things that we see sometimes happen with divorce situations is you have what might otherwise be a sole proprietor, but both spouses are working in it. So is that a sole proprietorship or is that a partnership?
I mean, you need two or more people working to make a profit at some endeavor to have a partnership. So that could certainly be characterized as a partnership, a general partnership.
Yeah. But aren't there some ways that you could say, no, it's still a sole proprietor if you wanted to? I mean, isn't there kind of an argument that can be had in that?
I mean, and I look at it from a tax perspective
Sure.
a lot. From a
Right.
tax perspective, it is not a partnership. It's a sole proprietorship. It's just the way that the IRS looks at it. And normally you'll see the tax filings as a sole proprietorship. But from time to time, we'll see partnerships with husband and wife as partners. So people operate them differently. Now, be interested to hear what you guys have to say about whether those are really partnerships.
Mm-hmm. I wonder if there's what the benefits could be to somebody saying, yes, we're partners, or no, we're not partners.
Well, the court can't do anything with the assets of a partnership because
Right.
it's an entity, where the sole proprietorship assets are divided individually as opposed to the equity in the entity. So it's a big difference.
So we've got sole proprietorship, we've got corporations, we've got partnerships. And then under corporations, we've got limited liability corporations, we've got S corps and C corps. Under partnerships, we've got general partnerships, maybe a limited partner, some family limited partners.
Well, the limited liability company stands on its own. It's a hybrid entity, and it has different attributes from corporations and partnerships. You get a charging order against a limited liability company, you can't kick the management out. You end up with, in effect, an assignee interest if you take an interest, but you can't kick the operator out of it. They're much stronger from an asset protection perspective than a corporation. So they're a little bit different, and we're seeing more and more use of those because of the advantageous asset protection attributes they have.
Yeah. And then what about, is it the same for partnerships where you have kind of the family limited partnerships or some of those different type of partnership entities?
Well, a family limited partnership is really just a limited partnership owned by family members. It's going to be governed by its partnership agreement. So it does have asset protection for the limited partners if they don't take an active role in the participation of the business and the operation of the business. And the general partner, which is normally nowadays a throwaway entity, get a judgment against it, who cares? It's got unlimited liability. But my understanding is the charging order defenses are not as strong as the LLCs.
Yeah. So then we have professional corporations. So what's the purpose and what are the benefits of professional entities?
Well, the only benefit to a professional corporation is to those who would like to sue the people operating within the professional corporation, because it provides the asset protection of a typical corporation, but for malpractice, and it provides no shield for malpractice. So like in my case, my licensing board requires me, if I want to use a corporation, to use a professional corporation to make sure that there's no shield there for malpractice liability.
Okay. All right, so characterization questions. So now we know that we have an entity. It's not a sole proprietorship. It's an entity. It's a corporation or a partnership. What are the things that you want to look for to determine, is it community property or separate property?
Well, certainly when it was started, and whether it's a corporation, when things were filed with the Secretary of State, it's always something to look at. But I mean, that's number one thing that I ask clients when they come in is, when was this business started? So, because if it started during the marriage, then you've got a community asset. And if not, then you've got a separate property asset, and then things are going to be a little different. So,
well, if you can trace the inception of title
Right.
for the capital that was contributed,
That's what I was going to say.
you can have a mutation and it can be separate property if it was formed the day before the divorce was filed.
Well, and I was going to ask you that question because you and I have had this discussion before.
Oh, yes, we have.
Is this question of inception of title with a corporation? So how, I guess I always believe in starting at the very beginning. I'm not going to sing the song. So starting at the very beginning, how is a corporation begun? Is it begun with the signing of an agreement? Is it begun with capitalization? How does a corporation begin?
Purchase of stock.
Okay.
And stock can be acquired by contribution of cash, services, or property.
To be hyper-technical, I'll disagree a little bit with what he's saying. The corporation is created when the Secretary of State does its filing. But what's more important for tracing is the inception title to that person is when they actually purchase some stock and pay some money.
Yeah.
So yeah.
Totally agree.
Yeah. Well, and that's why we have these discussions. So the corporation may be created by the filings with the Secretary of State, but the person wouldn't necessarily own it.
Question one was, when was the company started? Question two is, when did you pay to get some stock in this company?
And
Because
what did you use to acquire?
Yeah. And so most of the time, do you find that people use a check that they write to the company, or does it just kind of poof get created?
I think the poof created is probably the most common approach.
Right.
Because people normally don't follow the intricate details that their lawyers give them in written instructions to follow.
Yeah.
Every now and then you'll find one where someone actually wrote a check for their stock. But in most cases, it's going to be property or services as opposed to someone writing a check to get their stock in a closely held environment.
Right. So if you've got one that maybe the corporation was created during the marriage, but let's say it wasn't the poof method, it was actually the writing the check method, and the check came from separate property. What do we do with that?
It's a mutation of separate property, and it's separate property stock.
And there's going to be a lot of litigation over that.
That's how we make our living.
So there could be a difference between the simple rule of the company started during the marriage versus here's some evidence that I wrote the check to purchase my stock out of my inheritance account that I got from grandma.
Yes, and then you have to look at the inheritance account to see if there was any interest or dividends in it And was it a straight separate property check, or was it a mixed character check?
And so what standard would you apply to that tracing?
Well, normally we just do community out first, and if there happened to be some community in there, then it bought some of the stock.
I always think of the community out first rule as like a glass. And if you put a penny in this glass, it's going to sink to the bottom. So the separate property sinks to the bottom, and then whatever's on top of it is the community. And so you drink the community out first.
I use the oil and water. I figure
that's probably
the separate
better.
is the water and the community is the oil.
Yeah, yeah.
Very thirsty after this conversation.
Yeah. So what if it was a contribution of stuff in exchange for your interest? Like let's say, I owned some computers, and my contribution to starting the business was, here, company, here's all my computers.
If the computers were your separate property, it's a mutation of your separate property, and it makes it separate property stock.
Do you find that most corporations would have written documentation of that type of transaction?
No.
Thus the poof problem.
It requires you have to find other sources to prove it up. A lot of times testimony of other unrelated parties that were involved in the transaction. But it's not unusual to have that happen where, well, I just threw in, this land I owned, or I threw in some computers, or I had some accounts receivable,
or had a client list.
Or had a client list, or whatever it was.
Yeah.
You really, at that point, need to go to the other owners or the attorney that was involved in the transaction, and get some testimony to back up what happened.
Right. So let's move kind of to the division questions. So with corporations, we were talking about this during the break, and so I want to make sure we get to it and give you time to talk about it, Robert. Salary versus distributions in corporations. Is there a new question about that?
There is. With pass-through entities, and what we find is most corporations in a closely held environment make S elections, which means the owners pay the tax on the income whether they take it out or not. It's called a flow-through entity. When they passed the Tax Reform Act and lowered the C Corp tax rate to 21%, they created a free deduction to flow-through entities, except for people like lawyers and CPAs and doctors who were statutorily excluded from this little benefit. But if you're not one of us, you get a free 20% deduction for whatever income's attributed to you from a flow-through entity. But your salary doesn't count on this deduction. So there's some tension created now between what you call salary, what you call distribution, so you can maximize this deduction. And the IRS is aware of this, and they're going to be challenging salaries. But you're probably going to get used to seeing a different dance about what people call salary and distribution. And it's not because they're trying to defraud anybody, they're just trying to reduce their tax.
And how does that affect the value of the business itself?
Well, when you're valuing the business, you don't really, if you're valuing a controlling interest, and here normally in a closely held environment you are, but if you're valuing an interest that can influence what salaries are, you don't really care what they're paying themselves. You go out and find out what a replacement cost would be to replace the party to the business, and you're going to use that. So it really doesn't matter to you what they're paying themselves. A lot of what we do in that case is not only figure out what they're paying themselves, but what all the personal stuff is they're running through.
Right.
And you just have to, if you're trying to figure out what they're getting out of the business, you got to look at the salaries and the distributions, and you're probably going to see a heavier weight toward the distributions for these companies that qualify for the 199A deduction. now.
So was there anything else about the new Tax Reform Act that has changed how you approach valuation?
Well, the 21% I referred to as C Corps definitely increases the value of C Corps. I think there's an argument as to whether it should be applied to S Corps, and I can see both sides of that argument, and not sure who's going to win both sides of that argument. But if you'll recall, right after the Tax Act was passed, the market jumped up. And the reason the market jumped up is their tax expense dropped. Their net earnings increased. So you apply those PE multiples to the new earnings, all of a sudden the stock's worth more money. Mm-hmm. Well, that's what's happened on private companies as well.
Gotcha.
The tax burden is not as large, and people are willing to pay more. With a flow-through entity, that's a more difficult question. To me, is the most likely buyer going to be an individual that's going to continue a flow-through entity, or is it going to be some public company? Mm-hmm. So I think there's some judgment you have to apply in what tax rate to use, a closely held flow-through entity.
And then was there something that changed about depreciation and some of that's affecting valuation?
Doesn't really affect valuation. It just affects the tax costs. But
okay.
There were some errors made in the tax law that made things that were depreciable over a short period of time or immediately now depreciable over 39 years. And Congress doesn't seem to be getting along well enough to do a technical corrections bill to fix it. But I don't think the depreciation really is changing the values, because we normally value it without depreciation being considered. We're more worried about what's their capital expenditure expectation than how they write it off.
Right. And then what about the net operating loss? Is there something about that that's changed?
The net operating losses have been limited as far as how much of it can offset your income. And then also the carryback is no longer available. It's all carried forward. That impacts how you settle your cases. The NOL might not be able to be used quite as quickly, and the carryback, you're not going to get without a carryback, you can't get an immediate refund if you have a situation where they have a loss.
Okay. So Jere, how do we divide a corporation or a partnership in a divorce? Like physically, do you go down and you use a chainsaw to cut the business in half?
Well, no, I hope not. Or
I had somebody one time who
have
thought
a good criminal attorney if you plan to do that. But
the only thing these people had was a truck, and literally she thought you'd take a chainsaw and go cut her half of the truck down.
If you have corporation, what you're dividing is stock. You're not dividing the assets of the corporation. And you have, you really only have a few options. You can divide it in kind, which means each party is going to get some stock. You can give all the stock to one party and balance that out with other assets. If there's not assets to balance that out, then the court can agree to some type of money judgment, which hopefully you secure for your client so it actually gets paid. And if kind of the fallback option generally is we can't divide in kind and none of that's going to work, so let's sell this thing and we'll divide the cash from the sale. But again, it's not the underlying assets of this entity, it's just the ownership interest that you're dividing.
So it's just the stock.
Right.
What about a partnership? How do you divide a partnership?
Same basically. A partnership, again, you're not dividing the assets, you're dividing the ownership interest in that partnership. And the options you had with a corporation are the exact same with a partnership. And, that's that.
And Ryan, so how do you divide a sole proprietorship?
Oh, I mean, that's just regular, it's just part of everything.
Yeah.
So, I mean,
all the assets are there.
Everything's there. I mean, and going off to Jerry's points on dividing some of the other things, you can go with other routes. I mean, you could go with, converting it to a different type of corporation or something like that. I've seen other cases where they've done some sort of split off or something like that, where someone's getting, some sort of types of shares, but maybe they be advisory shares or something like that, where they're not involved in the day-to-day running of the business, but they still have a portion that they can continue to use. It just, a lot is going to depend on what can be negotiated on that front. So.
And how the agreements are written, especially with partnership agreements. Normally, you don't transfer a full partnership share. You have your partner who can get full shares, and the other person's going to get an assignee share, the other spouse. And so they're not going to have any managing rights to that partnership.
Right.
Good luck getting a distribution.
That's right.
Yeah.
We're going to get to all the problems with doing it that way.
Yeah.
So,
Well,
and there's a lot.
And one of the mistakes I see made, so frequently by attorneys dealing with these types of entities is you show up at the mediation or you read the inventory and they've got the corporate accounts listed with the other cash accounts. They've got the accounts receivable listed as an account receivable, and none of this is an asset of the community. And it screws everything up. So I would encourage anyone listening, please.
Make your inventories clean.
Yes, keep your inventories clean and don't show up at mediation with a spreadsheet with those assets on them.
But they should if it's a sole proprietorship.
Sole proprietorship, absolutely.
Oh, if
But
it's
an
a sole
entity-
proprietorship, you list every screwdriver
You
and
bet.
every tool and every bank account and everything. But yeah, that's one of my pet peeves when we're drafting inventories around here, and something that I think a lot of times clients don't understand, and that comes because many business owners either don't know how or just don't respect the formality of the entity, and they treat it more like a personal bank account than they should, which then gets everything a little mushy. And I find that a lot of times it's the non-controlling spouse who's not in control of the business, and they tend to think, well, that business account that has all that money in it, that needs to go on my inventory because that's where the retained earnings, the pot of money is, right? And it can be a little confusing. I even had a case recently where they had all the business income running through an account that was in this one spouse's name only, not even in an entity name.
I had one of those. We ended up doing an alter ego on that one.
Well,
Worked out quite well.
And in Section 3, we will talk about alter ego and piercing the corporate veil, or reverse piercing as it's technically known. But yeah, so I think that one of and I think this may even go back to kind of one of those beginning the case kind of questions is, are we respecting the corporate entity or the partnership entity? Are we respecting kind of the formalities? Or is this one of these deals where, it's just kind of a free-for-all? So I think that's a real important question.
Well, and I've had that especially with partnerships, especially if they own a bunch of land. Sometimes they'll have a bunch of partnerships where they own land. But when you talk to the clients, that's not how they look at it. They look at, well, I'm going to get this piece of land and you're going to get that piece of land, and that's how they want it divided. And so, a lot of times the end looks like a dissolution of a lot of partnerships, and then, that's tied in with what we're actually doing with the underlying assets, because they can't think entity, they think asset. And so sometimes you have to cater to the client's brain so that they can process it.
Yeah.
True.
So just kind of making sure that we've covered our basics before we go into Section 3 and talk about kind of the more detailed valuation issues. In a divorce, in the division of property, the first question then is this a marital asset? In other words, does husband or wife own it at all? Because like if it's the car and the car is in the company name, it's not even a marital asset. So identification of the marital assets, what actually do we own, is kind of the first step in that basic approach. And then the second step is, is it community property that we've gotten during the marriage and therefore subject to division by the divorce court? Or is it separate property that was owned before the marriage or that we got through a gift or inheritance that would not be subject to division by the divorce court? And then the third question then comes kind of where we start valuing things. Because to divide, the court ultimately has to divide the community property assets in a just and right fashion. That's the standard in Texas. So identifying what are the community assets, and then we have to put values on them, because if you don't have values on them, you don't know if the judge has divided them fairly and rightly, or justly and rightly, at the end of the case without having actual dollar figures. And there's actually some case law that we'll post in the group that talks about it's actually the judge's responsibility, independent of the lawyers and the parties presenting evidence, but it is the judge's responsibility to make sure that everybody presents sufficient evidence on value so that the judge has the information to base an opinion or base a ruling on. And there's actually case law that says if the judge doesn't receive sufficient information on value, the judge can refuse to rule. And we've seen that there are a couple of cases on pension plans where a lot of people don't actually go value their pension plans. But sometimes we see that even on business entities. I've seen a couple of cases in the last, 6 months or so, where lawyers don't hire CPAs like Robert Bales to value the corporate entity, and they just kind of think, oh, well, I don't even know what they're thinking. Like, we'll just pretend like we don't have a value. I don't know. And nobody values the corporate entity, so you can't really get down to what is a just and right division of community property, because this maybe big or maybe small asset doesn't have a number on it, right?
Correct.
And so that is your purpose in life, right?
I love it, yes.
So kind of getting those basics down, we've talked about how do you know if a corporation is community property? How do you know if it's separate property? What are some of those little intricate issues? How do we know if a partnership is community property or separate property? I mean, is it just kind of the poof, when does the partnership start existing? Is it when the partnership agreement is signed, or both? I don't know. What do you think about?
Partnerships are more difficult than corporations. Yeah. And really it's what do you, or it's fact specific, and what created the inception of title for that partnership interest. And I've seen cases where it was just contribution of an opportunity they had, where I have this opportunity, I'll put it in the partnership. And it's a legit and tangible asset.
Yeah.
Put in the partnership, contribution, inception of title. But what the most common frustrating thing that occurs with partnerships, sometimes with corporations, is someone goes and opens up a bank account with $1,000. They take $1,000 out of their checking account. Well, I just needed to open one up because we needed to have a bank account.
Yep.
And then they put $1 million of separate property into it the next week.
Yeah.
So do you have a community property partnership with $1 million reimbursement claim against it? Or do you ignore the $1,000 de minimis capital contribution?
Yeah.
So it's very fact specific. I mean, and the beauty about not being an attorney is I get to come to you guys and say, what is your opinion with regard to the inception of title on this entity? Because I can't testify to that. You're going to have to argue it.
Yeah.
And then you guys give me, but I try to give you as much guidance as I can.
Right, of course.
But that's where you guys have to make call some balls and strikes to determine, based on the facts, and our job is to give you the facts, when was that inception of title?
Yeah.
And it's not always clear.
And that's, I think, one of the struggles for clients is, those times when it's not super clear. I mean, the super clear ones, if it was an entity, a corporation started 3 years before the marriage with the contribution and the documentation with the secretary, and everything happened 3 years before we ever even met this person, I mean, that's fairly clear. But, all these things that can happen as life happens, that creates kind of the muddy waters. The tax laws change. So now the accountant recommends that we change the entity format from this format to that format. And then all of a sudden what started before the marriage converts in the middle of the marriage to a something else, and then you've got a question you have to litigate.
Yeah, and was it a legal conversion, or was it a liquidation and a reorganization?
Sure.
And
I mean, there's case law that'll break your heart.
Those can really hurt you if you don't do a true conversion.
I mean, there's a case where he distributed to himself and then transferred over to the business to start. Community property business.
All you had to do is do a conversion.
And it would have been separate property. And that was millions of dollars
and
that
that's
he gave
because
away.
sometimes they don't think about getting a divorce in advance. They think everything's hunky-dory, and they, go on the advice of people that don't operate in divorce land.
Right.
And, and accountants or business lawyers are making the best decisions they can make for them the way they see the world through their rose-colored glasses, without thinking about the future and the possibility of divorce. And then all of a sudden we get involved, and it's like, ooh, wish we had been involved then so we could have given you some better advice.
Sometimes we have some bad news to give.
Yeah.
It's not fun.
All right, so that wraps up our section 2 on what is the asset and how does it get divided. The third section is going to be on valuation issues. And we're going to talk about valuation methods and approaches, and how do you put that dollar figure on the asset. So we will be right back after a little bitty short break, and we'll start section 3. So join us. Hang on. Keep in mind that this is a webinar that's aimed at attorneys. This is for continuing legal education. If you're out there watching this webinar and you're not an attorney, we welcome you to watch it. But remember that we are not giving you any specific legal advice. We cannot comment on any specific case or situation without knowing all the facts. So if you need legal advice, this webinar is not a substitute for legal advice. Please, please seek the advice of a lawyer as to your specific situation and get specific advice to that. Because if you rely on just what we're talking about here, we're being general. We're talking about general legal principles that may not actually apply to your situation. This is for continuing legal education only, and we cannot create an attorney-client relationship just through the video camera. Okay? Thanks.